Okay? Then, that's part A. What would part B be? B says do it on the completed contract method. What would be the gross profit you would recognize in 2017? Zero. In 18? Zero. In 19? 290. All of it is recognized in that year. Listen to me. On the completed contract method, as long as you still think you're going to be profitable, don't recognize anything. But if you know you're going to have a loss, recognize a loss as soon as possible. As soon as it becomes known, I should say. Are you with me?
They just asked for the estimated, gross profit. So wouldn't we just stop at 2? I mean 1?
What's this estimate?
It says estimated gross profit, so wouldn't we just stop?
Well, that's a problem with them.
Yeah.
Because
So it should say recognize.
it's, I mean, all of these are estimates until the last year,
Okay.
right? But you should recognize no gross profit in year 17 because you think you're going to be profitable. You should recognize no gross profit in 18 because you still think you're going to be profitable. And in 19, once the job is completed, we can recognize the entire 290. They should not put the word estimated in that sentence.
Yeah, I was talking about for A, but for B, you do the whole thing if you go down.
No, for A, these are the answers. I mean, because this is an estimate at this point, this is an estimate at this point, this is the only one that's hardcore known at this point. So, but yeah, they want the answers to all 3 of those is what they're asking for. When you do the Gleim questions, you will see, it may ask something like, I mean, you'd almost have to do this, and it will say, what is the amount of gross profit that should be recognized in year 3 of the contract under the percentage of completion method? So you kind of have to do everything to get to 65,000, because you can't really, I mean, there's just no other way to do that. But as long, and this, now folks, don't try to outguess me. I have told you that there are different sets of exams for each semester. One semester, there's going to be a problem more like what we did, the 5-step process, and having multiple performance obligations and having to allocate the transaction price to those multiple performance obligations. There's a problem like that on one of the exams, on the final exam in one of the semesters. There's also one of these in one of the semesters. I used to tell people when they took the CPA exam, when I took the exam, this is what it was. You had about a 10% probability of passing all 4 parts on the first attempt. However, if you took it 4 or more times, you had about an 80% chance of passing the exam. So I would tell my students, eventually they ask something that you know. The first time you took it, you didn't know statement of cash flows, and you thought there were 100 points on statement of cash flows. But you really knew percentage of completion, but it wasn't even on the exam. The next time you took it, they asked you percentage of completion, and you said, something I know. Let me show them. I had a buddy a few years ago, he had a finance degree from here. He came back and took all the accounting classes to go sit for the CPA exam. He took it before I did. I mean, he was ahead of me. He went to Montgomery when you had to take all 4 parts in 2 days. He failed all 4 of them. He came back and said, that's the worst experience of my life. I'll never do that again. Ever. Done that. Through. Not gonna do that again. 6 months later, he slipped up there, didn't tell me. And this was when you had to pass, you had to take every part that you hadn't passed. You had to make a minimum of a 55. So they forced you to study for all of them. You couldn't make a 92 on one and a 32 on the other one and keep the one you made the 92 on. No. You had to make a minimum of 55 on all of them in order to keep any that you passed. And you had to pass 2. You couldn't pass 1. They forced you to study for all 4 of them, is what they were doing. Now you can take them one at a time, so you don't have to worry about that. But the second time he went up there, and he didn't tell me, he passed 2 of them. So he came back and told me once he got the grades. Then he slipped up there 6 months later and took the other 2 that he had not passed, and he passed 1 of them. And then he went up there for the 4th time and he passed the other one. Now, he will tell you that his CPA certificate looks just like mine. And it does. Darn it. Mine doesn't say he passed it all in 1 time. He went 4 times, or he went up there 32 times. So it does look the same. And then people who've been in my office notice my CPA certificate. It's about as big as that board, the middle board there hanging over mine. And people say, "Did you blow that up?" And I'm like, "No, that's the size it comes." No, it's big. It's just, it's bigger. It's the biggest. I have a CMA, a CFM, a CGMA, a doctoral degree. This is easily the biggest. It's bigger than all of them. So, and I will tell you, it'll probably mean more to you, your career, than the degree will. Because, let's face it, folks. If you were to go, I'm friends with a former student who now lives in Oregon. And she just posted this weekend, she was out with her husband and kid, and another beautiful Oregon weekend over there. Now, do you really think when she applied for a job, they've ever heard of the University of South Alabama in Oregon? No. But if she's a CPA, they know she took the same exam they took. And they know this is a bar way up here and you got over it. That's what the CPA credential does. And it qualifies you for jobs that you could not have, for example, in a CPA firm. If you do not have a CPA, there's a ceiling, and you can't go past that. Because you have to be a CPA to move past that. If I urge you, if you're wondering about what it is you want to do career-wise, I would urge you to go to, I've never been on Indeed.com or Eric'sJobs.com or any of those, but years and years and years ago, I went to Headhunter.net. I don't even know if it still exists. And I went to large cities, and I would look at job descriptions. And when you look at job descriptions, you'll figure out very quickly whether that sounds interesting to you or not. If it says you're going to have to do a lot of statistical modeling, you need to be very good at Excel and all this other kind of stuff, and you say, "Oh, no, I don't want to do that." Or if it says 60% travel, and you say, "No, I don't want to do that." You can get an idea very quickly what interests you. If I weren't doing this, I'd probably be in Atlanta doing SEC reporting for some public company. Coca-Cola, UPS, Home Depot, somebody like that. Because I love financial accounting, and I used SEC reports for years at the bank, and I got to where I knew that kind of inside and out, and that's what I would probably be doing if I didn't fall into this. So, and I would never have known that kind of job even existed if I hadn't been looking on Headhunter.net. So there are lots of jobs. For example, the job I got with the bank when I finished college, I did not even know existed when I was a college student. In my local bank, in my little small town where I grew up, there was the president of the bank, there was the secretary, there were cashiers or tellers, and there was a loan officer. That was it. A custodian. These are the people who worked in the bank. When I went to Birmingham in that big building there were hundreds and hundreds and hundreds and hundreds of jobs that I'd never even heard of. Asset liability manager, commercial credit analyst, financial analyst, loan review analyst, asset-based lending analyst, things I'd never even heard of that required accounting degrees and strong financial skills. So, I was talking to somebody the other day who said he or she didn't know what he or she wanted, I can't remember now who it was, what they wanted to do, and I'm like, well, you know, you gotta be for deciding at some point, because you have to start maybe trying to get an internship in that area or something. So you need, and we can't, there's no way for us, I mean, you know, the sexy one, do you know who the sexy, when you bring a person in to speak about what they do to either Beta Alpha Psi or the accounting club, do you know who that is? The career? FBI. Everybody wants to be an FBI agent and go after white collar criminals and everything else. Well, first of all, then they tell you have to be able to run a mile in 5 minutes or whatever. And then people are like, well, I ain't doing that, forget that. And I had a buddy who I used to work out with years ago. He was going to Tuscaloosa. He wanted to be an FBI agent since he was a little child. And he was going to Tuscaloosa and he was getting an accounting degree and he was playing intramural football and blew out his knee. And he could not run a mile in the allotted time. And he was a very athletic, small, wiry, muscular kid. Couldn't run.
Should have been around.
And then, so that was it. So, I mean, his whole career path just blew up in his face. But there, you know, those jobs are interesting and sexy and fascinating, but there's just so many of them. We actually, the last person I heard, she spoke in room 218, she was walking in the neighborhood. She was an accountant, I think a controller or something in her firm, and there was a person in her neighborhood who was an FBI agent, and she was out walking her dog one day, and they started talking, and he said, you know, you really ought to look into working for the FBI. And she was in Birmingham. And next thing she knew, she was working in New Jersey on the terrorism task force right after 9/11. I mean, so they liked her and she got in, but there's probably 1,000 people who don't get in. You know, if you've ever done something on the weekend that you wouldn't want to read about in the paper, the FBI will find out about that and they will turn you down. So, things like that. But I do urge you, because you probably have no idea the kinds of opportunities that are out there for someone who have finance and accounting skills. To me, those are the only two majors in the College of Business that are even worth considering. Period. But you need to find out about what those opportunities are. Okay, let's look at problem 11. If I work it up here on this board, everybody can see. Every one of the problems we've done so far, we've been profitable. We might have made less on the contract ultimately than what we originally thought. And I think in one we did the other day, we made significantly less than what we originally thought. But we haven't been at a loss position yet. This is the one assignment where you're going to have an overall loss. And that's why I wanted us to do it. On July 1 of 17, Torval Construction Company contracted to build an office building for Gumbel Court for a total contract price of $1.9 million. On that date, Torval estimated it would take between 2 and 3 years to complete the building. And on December 31st of 19, the building was deemed substantially completed. The following are accumulated contract cost incurred, estimated costs yet to complete the contract, and accumulated billings for 17, 18, and 19. And again, they're asking us to A, use the percentage completion method to calculate the amount of gross profit or loss to be recognized in each year of the contract, and then B is the completed contract method. All right, so Again, we do it in order. These are 17, 18, and 19, I remember that. The contract price is $1.9 million, and that doesn't change. Okay, minus my construction expenses. Will give me my estimated gross profit. All right, at the end of year one of the contract, we have incurred cost of $300,000, and we think we're going to incur another $1.2 million. So the estimated cost for the contract are $1.5 million at the end of year one. So we're thinking at the end of year one, we're gonna still make a profit of $400,000 on this contract. Now, I need to say this because a student mentioned this one time, and I would never have thought this. The student said, how do you know in 2017, let's go all the way to the end, 2,000,001. So I did step one all the way across. And then that student raised his hand and he said, I really can't figure out how you know at the end of 17 that you're gonna lose $200,000 on this contract in 19. I said, well, I don't know it at the end of 17. I'm doing this at the end of 17. Then I'm doing this at the end of 18. And then I'm doing this in 19. He said, well, then why are you doing it all the way across? And I had never thought of it that way. I mean, I just think it's easy to do step one, step two, and then step three. But he wanted me to do year one, step one, year one, step two, year one, step three. So it never even occurred to me that somebody could be confused about that. So the other day when I presented it, I did all the way down the first year. And then we did the second year. Today when I presented it, I went across. Did that bother anybody? Did you say, how did you do that? How'd you know that? I'm not looking into a crystal ball. I'm doing year 18 after year 18 has happened. So understand that, please. All right, so for year 18 in this case, I have incurred cost of $1.2 million at the end of 18, but I think I still got $800,000 in costs yet to be incurred. So that means my estimated costs are $2 million. So now, as of the middle year, I'm thinking I'm gonna have an overall loss. And that's gonna create some issues for me. So watch this. That's step one. Step two, determine the percentage complete on each year end. Cost incurred to date, $300,000, divided by the latest estimate of total cost, $1.5 million. That's 1/5, that is 20%. Okay? Now let's go to the middle year. Cost incurred to date, $1.2 million. Your estimate of total cost is $2 million. So that means you're 80% of the way there. No, 60%. 60%. And then the last year we're $2.1 million out of $2.1 million, so we're 100% of the way through. So then step 3, develop the income statement data. Long-term construction revenues. Okay? Take my 20%, multiply by 1,000,009, 10% would be 190, 190 is 380. Okay? Subtract my construction expenses, and this year it was 300. So my estimated gross profit, now you wouldn't put estimated on your income statement, but I want you to be aware, this is a guess, this is an estimate. We're thinking we should recognize 80,000 in gross profit this year. Now let's multiply our 20% times our 400,000 total gross profit. Is that also 80,000? Okay, so we're good. Then I'm going to create the cumulative gross profit row. All right? So, here are my answers. I mean, there's my first answer. I haven't done the other 2 years, but I'm about to. All right, so now let's go to the next year. 60% times 1,000,009. That's how much revenue you should have recognized in year 17 at 18. Subtract how much you recognized in year 17. How much should I recognize in 18? Ms. Jones? Huh? 760? Okay, 760.
Can you repeat how you got that again?
I multiplied 60% times 1,000,009. That's the total revenue for these 2 years.
Yeah.
Then I gotta subtract the 380 I recognized last year, and that tells me that's how much I need to recognize this year. Okay, but now watch this. Now I realize I'm going to have a loss. Or at least I think I'm gonna have a loss at the end of the second year. So watch this. How much is my cumulative gross profit that I need to have recognized by the end of year 2? Okay, listen carefully. How much is the cumulative gross profit that I need to have recognized by the end of year 2?
100,000.
100,000. Right? That's how much I think I'm gonna have. So I need to recognize it. But I've already recognized 80,000 last year. So how much does this year's loss have to be? 180,000. So now we plug for the expenses. So 760 minus 940, is that right?
So when you're operating with a loss, you sort of throw it out the window and go to the loss.
Yes, because in the interest of conservatism, which you should have studied in 371 when you were talking about the conceptual framework, we say, look, we now think we're gonna have a $100,000 loss, so we gotta wipe out any profits we've recognized in the past and recognize that full $100,000 loss in the year that it becomes known. Are you with me? Okay, so now we go to year 3. So now I'm 100% of the way through. So Mr. Rollator, I would multiply 1,000,009 times 100% and then subtract this revenue and this revenue. And by default, that's how much revenue I need to recognize here. That is 1,140,860.
Yeah.
Is that right?
I got 760.
That's 760.
760, okay, just checking. All right. So now again, because we still got this weird situation, now we want a cumulative loss of 200,000. And you had 100 last year, now you want 200. Therefore, I need to recognize 100 loss this year, right?
So you subtract 860.
Therefore, my expenses are a plug again of 860. So now the answers are, now this is important because sometimes students get confused. The answers are 80,000 gross profit, 180,000 gross loss, 100,000 gross loss. That's part A. What would the answer be for B?
Zero.
0,
$100,000.
$100,000 loss, and then $100,000 loss. You really need, I don't think, I've never seen in the book them talk about this cumulative row. But you really need to make sure that your three recognized gross profits or losses total what the overall status was.
What, I'm sorry, can you say what you thought B should be, or what B should be?
It should be 0, $100,000 loss, and then $100,000 loss. Because we gotta have a $200,000 loss overall, right? And we would have recognized 100 of it in 18, so then we gotta recognize the other 100 in 19.
So you'd always have to do, the revenues minus the expenses, you couldn't just do the percent to get to the,
Because if you do the percentages, see if you get these answers.
I did,
Do you get the expense answers?
no, not expense, that's
Okay.
total estimated profit for each year. Or loss.
Just, I know how she got it, but I didn't really like, I knew.
Tell me what you did in 18.
In 18.
Yeah, what are you talking about? What did you do?
Come up with the $100,000 loss that you have to recognize. Then you go to the.
Well, wait a minute, I didn't recognize $100,000 loss in that
You
year.
did
Well,
one
from the
A.
estimated, from the top part, number one, the.
Oh, well,
first
yeah, okay, that, all right.
And then I took, because you've got to subtract out either your profits from the year before. So you have a negative and a negative, so you would add. So you get the 180 for the step 3 of the gross loss that you recognize in 2018.
You did the same thing I did, you're just explaining it differently.
Yeah,
Because,
same
I mean, because I said this and this is what would give me that, because I've gotta be to this point, so you're just explaining it differently.
You might wanna know construction expenses, and that's the only way to get something like that.
Right.
Okay.
So we have done 2 or 3 or 4 where we were profitable, sometimes less profitable than we thought we were going to be. And we've now done one where we were in an overall loss situation. And we've done them for both percentage of completion and completed contract. I don't really think completed contract is that hard, as long as you remember that for completed contract, if you think you're gonna have a loss, recognize it as soon as you become aware of it. As soon as you expect it for the first time. And you don't recognize, in this case, we're only 60% of the way through at the end of year 2. We didn't recognize a $60,000 loss. We recognized that loss in its entirety in the interest of conservatism. As soon as you think it becomes known, recognize it in full. Only profits do we recognize percentage-wise. Questions? Okay, now, chapter 18 in my thinking is 2 distinct parts. The first things that we did last Tuesday and the first part of Thursday was the new revenue recognition standard, the 5-step process, determine the contract with customer, identifying the performance obligations, determining the transaction price, allocating the transaction price amongst the various performance obligations, and then recognize the revenue associated with each performance obligation as soon as you've met that performance obligation. Then there's this construction issue of long-term construction contracts. So if we were an electrical contractor who signs a contract and comes in and in a month has the job done, we're not going to worry about long-term construction. This long-term means it's going to be fiscal years. So we have to find some way to recognize that. And some examples are building that building out there, building a great big mall. If they in fact wind up moving the airport from West Mobile to Brookley Field, that's going to be a big contract that will be a multi-year endeavor. Paving, I mean, you know, you're talking about repaving the interstate. I mean, it's going to take you a year to drive to Birmingham when they do that. And it's going to take them a couple of years to do it. So those are the kinds of things we're talking about. Not just all contract accounting, it's long-term contract accounting. That's why I put the LT, long-term construction revenues. And it's full of a lot of guesses. Yes, ma'am.
My brother-in-law, I was doing climb out there, they're in town, he's from Pittsburgh, but he works in this kind of stuff, and he said, oh, it's funny you're studying that. He said, you know about warranties? I said, well, yeah, I know y'all gotta keep them on the books and all that. Well, apparently they're hiding revenue. They're saying the job is not complete, but it is actually complete, but yet they're not clearing out their liability account, their warranty account. So the auditor has said, I know what y'all are doing. I was like, I guess y'all could hide money there. They're saying the job's not complete and still keeping the liability, but the job's been done.
The liability related to what?
Warranties, like that they could bring something back, even though nobody's gonna bring anything back.
Ah.
But the job's complete. So I was like, of course she's recognizing this. Things have stopped, I would imagine. But yet you're keeping this going.
I would hope there's an outside auditor who comes in and
That's,
fixes
he just said, oh, that's funny. We just had an hour-long conversation with my boss about it. I was like, yeah, because, yes, she recognized it. I said, I can see why.
I had a former student call me year and a half ago. He had taken a job in Birmingham, and his the owner of his company, it was a trucking company, I believe, had a lot of personal expenses that were being run through the business, like the mortgage payment on his beach house and the boat and the sea dues and all that stuff. And he called me and said, I'm a CPA and I have the AICPA's code of ethics to abide by, and I'm questioning what's going on here, and should I be working here, and should I say something? And I managed to talk him off that ledge by saying, you don't know what the auditors do when they come in at the end of the year. They may take all of these personal things, add that up, and then put that as compensation to him, and he has to pay taxes on it. That's what should be being done. But I said, you don't have to create any kind of a stir now. What I would do is once an audit firm comes, and they did get audited every year, once the audit firm comes in and does their thing, I would compare the final results of those numbers with the raw numbers that you see and see if in fact officer comp has gone from 200,000 to 600,000. Because, people who own their own business do like to act like it's their own cookie jar. Because they say, well, what's the difference? It's my company, what difference does it make? Well, if you're going to have a business entity, you can get in trouble. It's called piercing the corporate veil when you treat a corporation, which is supposed to be a separate legal entity, like your personal checkbook. There are rules and regulations concerning that, and you shouldn't do that. because you could get in trouble with, eventually somebody could say, no, you don't have corporate protection anymore because you are, in essence, a sole proprietorship. So now your trucking company has been in an accident, run over somebody, and we're not just going to sue the company, now we're gonna sue you. We want that beach house now. And you've given up your corporate protection because of what you've done. But still, it's hard to convince some people to do what's right. What makes more sense? Okay. So I hope I impressed upon you the importance of not saying, ooh, it's gonna be a percentage of completion problem from chapter 18 on the final. You should know both what we did, the first part of the chapter and the second part of the chapter. Be prepared for either one. All right? Questions before we go to chapter 19?
Are you gonna unlock the homework today?
Yes. If you'll remind me. I'll try to remember when I go to my office. All right. Chapter 19 is accounting for income taxes. Okay, now, a lot of times students get confused. Please understand what you did in Principles 1 and most of what you did in Principles 2 and what you did in Intermediate 1 and what you've done in Intermediate 2 all revolves around financial accounting. The rules, the regulations, the procedures that are employed in preparing financial statements prepared in accordance with GAAP. When you go to 331, taxation of individuals, now you're doing federal income taxation. Whole different set of rules. So when I say something in here, and I say, why do you think we do it that way? The answer is never because of income taxes. Because GAAP doesn't care about income taxes. The Internal Revenue Code cares about income taxes. So it's just, think of it this way. If you have a foot problem, do you go to a cardiologist? No, you go to a podiatrist. If you have a lung problem, you go to there are different specializations. Accounting has the same thing. There's financial accounting, there's income taxation, there's managerial cost accounting, there's government not-for-profit, there's auditing. These are all distinct fields in the world of accounting. And we're doing financial accounting. But here is the one place in all of financial accounting that we bring together, we try to reconcile the differences between GAAP and Internal Revenue Code. This is the chapter we do it in. And when I studied this material, this was the hardest material I ever encountered. Now, students have told me in recent semesters that the statement of cash flows, which we do next week, is the hardest thing for them. But but you got me. I'm going to be teaching you that, so I don't think that's that bad. I didn't have me to teach me the accounting for income taxes. I had to struggle. But this is similar to the bonds payable chapter. If you know 4 or 5 little pieces of information, you're good to go. If you don't know those 4 or 5 pieces of information, you're like those little 12-year-old kids in the cave. You are screwed. You are in trouble. Okay, they're out now.
They survived
But for 2
the
weeks,
show.
and they have pneumonia. They're sick. All right. Here, I'm gonna use an example to illustrate what we're trying to do in this chapter. You're familiar with straight line depreciation, right? Okay. And lots of companies use straight line depreciation for financial accounting purposes. But they probably don't choose that method for tax purposes, do they? Why? Why would they choose a different method? And what method, well, let's just do that. What method might they choose? What type of method might they choose for tax purposes?
Double declining.
Okay. That, and what is double declining, some of the years digits, makers, modified accelerated cost recovery? What are those collectively known as? Accelerated methods of depreciation. So why might a company choose an accelerated method of depreciation for tax purposes and the straight line method for financial accounting purposes?
Because they want to lower their income.
Hmm?
Try to lower their income.
Try to lower their taxable income, right? Because, I mean, think about it, folks. If you paid $1 million for the piece of equipment, the question now is, how much of that cost are we going to be able to put on our income statement, our GAAP income statement, versus how much of that cost we're going to be able to put on our tax return? And since we're talking about an expense, we want the cost on the tax return to be higher, right? That gives us lower taxable income, which means we pay less in taxes in the early years, right? So let me give you an example. Let's say that for GAAP purposes and then for tax purposes, we have a $1 million piece of equipment with a 5-year useful life, no salvage value. It's going to depreciate at $200,000 a year for 5 years. For straight line. Okay? For tax purposes, let's say in the first year using the modified accelerated cost recovery system, makers, it's 300, I'm just making this up now, 350,000. And then 250,000. And then 125,000. Somebody help me. That's 725. No, I can't do that. I gotta do more. Let's do 175.
Don't you gotta do something like 400 for the first one? Like double declining would be
This
what?
is makers.
Take the million divided by
Yeah.
5
Yeah,
and
this is
double
not
it up?
doing mine.
But I'm just making it up. But all I'm trying to do is start out with lots more under the accelerated method and then less later on, because when we finish, we're going to have recognized $1 million of depreciation in both methods. And this is part of the problem of trying to do things on the fly instead of coming in here with PowerPoints, which is all nice and pretty. That's 600, 775, so I'm 225, so 775,
Just flip those two.
let's see, 125, and then 100. See if that's right. 6, 775, 8, 9, that's $1 million. Okay, so it works. Are you with me? Okay, now. Piece of critical information number 1. In the year of originating temporary difference. Temporary difference. There are temporary differences and there are permanent differences. This is an example of a temporary difference because after the 5 years are up, I've recognized $1 million in expense here, and I've recognized $1 million in expense here. The amount that I recognized in any one year was different, but it eventually washes out. You with me? But let me give you an example of a permanent difference. Municipal bond interest income. Do you ever put municipal bond interest income on a tax return and pay taxes on it?
No.
But you gotta put it on your GAAP income statement because it is interest revenue. So there's a permanent difference. But right now, just write temporary, and I've done this before. Stay with me. Okay? I'm gonna call GAAP income FI for financial income. I'm going to call tax TI for taxable income. Okay? If financial income is greater than taxable income, if the income on my income statement is greater than the income that would show up on my tax return, then this gives rise to a deferred tax liability, which is also known as a future taxable amount. That's critical. A future taxable amount. Okay? What if the opposite? What if financial income is less than taxable income in the year of this originating difference? Then that gives rise to a DTA, a deferred tax asset, which is also known as a future deductible amount. Sometimes the book is going to call these a future taxable amount or a future deductible amount, or sometimes it's going to say gives rise to a DTA or gives rise to a DTL. So you have to know both terminologies. Are you with me? Okay, so this is due to one difference, depreciation. Right? So in the first year, this is an originating difference, right? So watch this. I'm going to put out here in the first year, the difference is $150,000. And it's originating, right? It's not reversing, it's originating. Okay, now, I want you to think before you answer this question. What is the relationship between financial income and taxable income in year one, given this scenario? Financial income is greater than, less than, or equal to. Did I say I want you to think? What do you say, Mr. Bland? Financial income is
Say less than. Like,
less than. Ms. Jones?
Is it the financial income?
Yes, financial income is,
Cause I thought you were taking only
Hey,
200 away.
this is what I want. I want financial income is greater than taxable income, financial income is less than taxable income, financial income is equal to taxable income, or financial income, I have no idea how it's related to taxable income. There are your answers, A, B, C, or D. Which one is it?
C.
Okay, everybody has to vote. How many say the answer is A? 1, 2, 3, 4, 5, 6, 7. How many say the answer is B? Did I say everybody has to vote? How many say financial income and taxable income are equal? How many say I'm clueless? Okay, so we got 13 people in here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Who did not vote? Did you vote, Ms.
I
Jones?
voted for the financial income grade.
Who didn't vote?
I think you missed one person on the equal to.
All right, how many say equals 2? 1, 2, 3, 4. Ah, there was the little hand there. 5. Okay. All right, I don't think the 5 are not getting this.
And the 2.
No, here's the deal. The only difference between what's on my income statement prepared in accordance with GAAP and my tax return prepared in accordance with the Internal Revenue Code, the only difference is the amount of depreciation expense. So if this is the amount of depreciation expense on my income statement, and this is the amount of depreciation expense on my tax return, they cannot be equal.
Honestly, I didn't know that those were the
I didn't
depreciation. I
know
thought
that.
it says income above it, so I thought it was income tax rate.
No.
It says financial income. It says
Okay, wait just a darn minute. How did I start this conversation when I said you bought $1 million piece of equipment, you're gonna depreciate it over 5 years with no salvage value, therefore it's gonna have $200,000 a year in depreciation? Maybe that's when you were in the bathroom or out walking the streets. Are you with me? I'll never forget that little smart aleck comment you made a couple of weeks ago when you said the difference. When I said, what is whatever, and he said, the difference. So, you're fair game from now on. I've moved off the finance guy, now I'm heading to you.
He's like,
I mean, it was like beating a little puppy over there. It was so easy. So it's a little harder to pick on him. Okay. So yes, this is the depreciation expense that will appear in my financial income statement, but this is still an expense. So if the expense is $200,000 on my income statement, or $350,000 on my tax return, now what's the relationship between financial income and taxable income?
A.
Financial income is greater than. This is the answer. Financial income is greater, therefore, this is an originating difference that gives rise to a what? Look up there. a DTL, a future taxable amount. How we doing? That's an originating difference. Okay, now go to year 2. This time it's $50,000 difference. Is it originating or is it reversing? Originating. Are you with me? Okay, now look at year 3. Now the situation has flipped. Now the tide has turned. Now it becomes a reversing difference. So now it's a reversing difference of 25,000. So now what is the cumulative difference? 175, very good. Okay, now look in the next year. 200 versus 125, this time it's a reversing to the tune of 75. So now the cumulative is 100. And then in the next year, the reversing is 100, and the cumulative temporary difference is 0. Now, this is a very common mistake, and this happens every semester. Students say, oh, okay, so in the first 2 years, financial income is greater than taxable income, therefore it's a DTL. Then they say, beginning in year 3, the expense on your income statement is $25,000 greater, so now financial income is less, so it becomes a DTA. When did you know cash? Can cash just move from one side of the balance sheet and come over here and say, now I'm a liability? No. If it's a DTA, it is a DTA for life until it goes away. It simply is no longer an originating difference. Now it is reversing and it starts coming due. Now I got to start paying it. I've deferred it. That's what deferred means, put off. But I can only defer it so long until this situation reverses. And then I have to start recording it. Are you with me? Now watch this. Okay, this is a brand new liability account. What is its normal balance? Credit. Okay, now here's the deal. The journal entry to recognize income tax expense on the GAAP financial income statement is this. Debit income tax expense. Sorry to bore you.
You're back in the box, man.
I thought you were done with me.
Okay? Now the good thing is income tax expense is a plug. Okay? Then DTA, deferred tax asset, that's a new asset account. That's a debit. All right, now watch this. The temporary difference that gave rise to it times the future tax rate. Just write them down and I'll explain what we're talking about in a minute. So you probably need to put a little asterisk by FTR and then down below write future tax rate. Okay? For DTL, it's the temporary difference giving rise to the DTL times the future tax rate. And then income tax payable is taxable income times CTR, the current tax rate. The current tax rate. Now, this assumes that you have a temporary difference that gave rise to a DTA in this year, and you had a temporary difference that gave rise to a DTL. We account for them separately. You with me? Okay, now. So in this first year, let's just forget about the journal entry now. I have a cumulative difference arising this year of $150,000. And I need to know what the future tax rate is. Now listen to me. That means what is the tax rate, the enacted tax rate, going to be when this thing starts reversing, when it starts coming due. Let's say, just for fun, let's keep it simple, 40% for all years. Okay? 40%. So, $60,000. Are you with me? Okay, now this is very important. Another element that can confuse you in this chapter. Sometimes they will tell you this company has had temporary differences that give rise to a $60,000 DTL. They're telling you the number that goes in the T account. Sometimes they will say the company has temporary differences of a cumulative $150,000. They're telling you this number. The cumulative number goes out here times the future tax rate. Are you with me? Y'all, you have no idea how good this teaching is right now. You have no idea. I'm just thinking I wish I'd had me back when I was studying this crap. I mean, I'm just laying it out so pretty that just you cannot not know this. Okay, in the second year, what's the originating difference originating this year? 50,000 times 40%. So that would be another 20,000, right? Now I'm not going to do it, but I want you to mentally do this. If you total this, it'd be 200,000, right? Times 40%, which would be 80,000, right? So imagine if the problem started and said you have cumulative temporary differences totaling 200,000. Then they're just telling you what the starting point is. Okay, now in the next year, it starts reversing. So now 25,000 times 40% is going to be 10,000. Ms. Jernigan, you have a calculator. Take 200,000 and subtract 25,000. And what is your cumulative temporary difference?
175,000
And
we would multiply that 175,000 times 40%.
is 70,000.
Whatever you said. 175,000 times 40% will give you what?
70,000.
Huh?
I thought it was 70.
Oh, listen to me. You did 200 and you subtracted 25,000, right?
Right, so you get 175,000.
Times 40%.
70,000.
I'm still getting 70,000.
He's just not saying it loud enough. It is
Okay.
70,000. He agrees.
Okay,
with
I'm-
you. He wants to do that.
Yeah.
It makes you think you're
So
wrong.
now you're at 60 plus 20 is 80 minus 10 gives me a balance of 70,000. I'm trying to illustrate the difference between what is the DTL versus how much is the cumulative temporary difference. Because that's going to be a source of confusion, I promise you. Every time you encounter one of these, you got to ask yourself, okay, what are they telling me? Are they telling me the number in the T account? Or are they telling me the number that goes outside the T account? All right, let's go to the next year. The next year we got 75,000 reversing times 40%. I believe that is 30,000. So now 200 minus 100 gives me 100 is the cumulative temporary difference, times 40% is my balance 40. There's 80 minus 40 is 40. And then my last one is 100 times 40% is 40,000. Now, it is originated and reversed, and the DTL has gone back to sleep. Questions? So now this is another thing that bothers students. In the years that it's being credited, increasing over there the first 2 years, we're crediting the DTL. But when it starts reversing, these are debits to the DTL. So then the journal entry, if these two reverse, just move them. The DTL becomes a debit, the DTA becomes a credit. Are you with me? Okay, now, let me give you an example of how knowing just a little bit can create harm. Bankers, commercial bankers, deal with customers a lot. And one of the typical kind of customers that they would deal with would be a long-distance trucking company. And here's why. Have any idea how much a tractor-trailer rig cost? A lot. When you say a lot, what do you mean?
Like $1 million.
Over $100,000.
Okay, that's what I meant. That's what I meant, $500,000. Wait, do you mean like an 18-wheeler?
Yes.
Oh.
I mean, this the tractor, and then the other's just a trailer. I mean, it's, all right? So it's well over $100,000. So when trucking companies want to buy new rolling stock, they typically go to a bank and borrow money for it, okay? So when I would teach my seminars and deferred tax liability comes up, I have a commercial lender say this. Well, what we do when we look at a trucking company is we will take that DTL, that deferred tax liability, and we just take it out of liabilities and add it to equity. And then recalculate all the ratios based on that. I said, really? And why do you do that? And he said, because that's an evergreen liability that never has to be paid. Oh, really? You don't have to pay the IRS. Is that what you're saying? It's a choice? What he's saying is this. Why don't we get to here when it starts reversing and go buy another tractor trailer rig? Start the process right back up there at the top again. Are you with me? Because now, if we put the depreciation on this new one and the depreciation on the old one, we've probably still got more depreciation on the tax return than we have on the GAAP income statement. Okay? And that works fine until now. Think about this. Suppose the economy is slowing. I don't know if you know this, but truckers are the first people to know when the economy is slowing down, and they're the first people to know when the economy is picking up. When it's slowing down, they've transported goods to stores and it ain't selling. And so they're not asked to transport some more. And they've done it every week for the last 4 years or 3 years or 2 years or whatever. And so it's become routine. And now all of a sudden they're saying, no, you don't bring us anything this week. They're like, uh-oh. And then they've sat at home for a few months while the economy's in the tank. And then they start getting a request, need you to haul some stuff. Now all of a sudden they know things are perking back up now. So suppose you get to this point and it's beginning of recession time. Does anybody want to spend $150,000, $175,000, $200,000 on a tractor trailer, brand new, just to sit out on the lot because you don't have any orders to transport stuff for it? No. So my point is, a DTL can become a very real liability that will bite you in the seat at the worst possible time. Because you can't really afford to go out and start this process over again. And now, commercial lenders will do a lot of things with numbers. They're like finance people. They know just enough to be dangerous. Whoever told them it's an evergreen liability that doesn't have to be paid? Number one, that's crazy. But number two, they didn't just say that. He said it's not really a liability, it's equity. So here he is. He's getting an account to get up and walk across the balance sheet and go somewhere else. How you do that, I have no idea. But I disabused him of this concept. They knew just enough to know that, well, look, I've got that liability sitting there in year one. Then I've got that liability sitting there in year two. And I hadn't had to pay a dime. So it is. A couple of years it's an evergreen liability. But what happened in year three? Start having to pay the piper now, right? Started coming due. Now our first problems in here are going to start with the tax rate for all years is flat. 35%, 30%, 40%, doesn't matter. Okay? Then they're going to say, okay, the tax rate in the first 2 years is 40%. But in years 3, 4, and 5 is 30%. Are you with me? How would that change what we're doing over there?
You use 30%, right?
We would use 30% in every single year because you care about what is the future tax rate when the thing is going to reverse. That's what you care about. Look. The taxable income would change based on the current tax rate. I mean, not change. It would be based on the current tax rate. But the future tax rates are when the DTA and or the DTL are going to reverse. And one might reverse in 1 year and one might begin reversing in another year. They don't have to follow the same process. You might have a DTA that's created in year one and completely reverses in year two. And then you got a DTL that's created in year one and in year two and then reverses in years 3, 4, and 5.
I guess I'm a little confused. You can't have a piece of equipment that creates a DTA and also creates a DTL, right?
No.
Okay, so these are, the thing you wrote down is for like the company.
Yes, for the company,
Okay,
yeah,
it's not
yes.
like one piece of
That's
equipment.
exactly right. You will have you can have a temporary difference that gives rise to a DTA for the company. And you can have another temporary difference that gives rise to a DTL for the company. And that's as confusing as we get. We have one of both in some of these transactions. For the most part, the most common is by far DTL. By far, it's much more common than, most companies never have a DTA ever, but they'll have a DTL. Because DTLs, I mean, if you think about it, the whole idea behind taxes is lower them as low as you can legally get them to get away with it. To lower how much you have to write a check to the Internal Revenue Service for right now. That is taxable income times the current tax rate. That is your income tax payable. Yes, sir?
If we have both of those, do we do it at net or?
No.
But both?
You have to record them separately. Then when you get ready to put them on the balance sheet, you net them.
Okay, sorry.
Are you with me so far? Okay, now let me think. We talked about what the journal entry looks like. Folks, you cannot do this chapter until you got this in your mind. You just can't. Because you're not gonna know whether to credit a DTL or debit a DTA. You have, and every time we encounter a difference in this chapter, what I would do if I were you is I would write that down and then analyze it and say, what's the sign? Is it this sign? Is it this sign? Or is it that sign? If it's a difference, it ain't gonna be the equal sign. It's always gonna be one of these. Right? So you then, once you say, okay, my income on my GAAP income statement is going to be greater. Okay, now you know it's a DTL. Right? You have got to commit that to memory. Yes, sir?
Is it more common to have a temporary difference or to have like just equal taxable income financial?
Oh, no. It's much more common that there be differences. Okay, now, there are temporary differences and there are permanent differences. The one we just talked about, depreciation, is a temporary difference. In year 1, there's a difference. In years 2, there's a difference. In year 3, there's a difference. Year 4, there's a difference. Year 5, there's a difference. But over the full 5 years, you've recorded $1 million worth of expense on both the tax return and on the income statement. Okay? So, in your book, there is a list of about 20 temporary differences. Listen to me, don't look. If it was so fascinating, you should have already read it. And there's also a list of 5 permanent differences. Which one would you rather memorize? The 5. Doesn't that make a whole lot more sense? So I'm going to give you the 5, and the good thing is they come in pairs. The first 2 come in pairs. And then, when you read one of these differences in these problems, if it isn't one of these 5 differences, then it's got to be one of those temporary differences, which means we record a DTA or DTL for it. Okay? All right, now listen carefully. You've already studied these. Everybody been in 331? Taxation of individuals? You've all had that, I think. Okay? Well, I gave you one earlier. Municipal bond interest income. That is because the interest income will show up on your GAAP income statement, but it will never show up on your tax return and taxable income. Okay, but now listen, here's the pair that goes with that. Think about this. Think how those young people are shady. What if a rich person said, you mean I can invest in municipal bonds and the income I get from that, I'll never have to pay taxes on? Yes, sir. Okay. I'm going to talk to my banker and I'm going to borrow $1 million from the bank and I'm going to secure it by these municipal bonds. And the interest expense that I incur on this bank loan, I'm going to deduct on my tax return. And then I never have to put the income on my tax return. So I'm going to win-win. No. Any expenses that you incur in earning tax-free income, those expenses are not deductible. So, municipal bond interest income and expenses incurred to earn municipal bond interest income are never taxable. So see, that's a pair. Both the plus side and the minus side go together. Okay, here's another one. For those of us who have worked for larger employers, they generally pay for life insurance because it's a very cheap benefit. Okay, but listen to me. If the company names itself as the beneficiary. You die and the company profits. Then the premium expense that they pay cannot be deductible. But then when you die and they get benefits, those are not taxable either, if the company has named itself the beneficiary. So, there is the benefit due to an insurance policy and the expense related to an insurance policy when the company names itself the beneficiary. Okay, and then number 5, fines and penalties due to the violation of law. Fines and penalties due to the violation of law. Okay, now I want you to think about this. We are an industrial company. We deal with hazardous waste sometimes. We generate some hazardous waste, and that stuff's expensive to get rid of. So what we do is we take it down to the nearest river and we dump it. And everybody downstream starts dying. Cows, horses, donkeys, everybody's just passing out. And they eventually, the EPA traces that back to us and says, oh, it's amazing that this is whatever, and that just happens to be a major component of your manufacturing process. So we think you did it. And we're gonna fine you $1 million for that. Okay, now ask yourself, would the federal government allow that company to treat that $1 million fine as a deductible expense in reducing its tax liability? No. But now I want you to understand why. Why not? Isn't that an expense just like paying a salary to your employees? Isn't it an expense just like paying insurance? Isn't it an expense just like paying utilities to keep the place air conditioned? Why would you not be allowed to deduct fine from a violation of law?
Because you don't want to get a benefit from breaking the law.
Ah, and that's right. So in essence, look, if your tax rate is 40%, then 400,000 of that fine is in essence paid by the rest of us. You only had to pay 600,000, right? Because you got the tax benefit of having a deductible expense. So it reduced your taxes by 40% of the 1 million. It reduced your taxes by 400,000. So me, sitting in my house, never dumped any illegal stuff in that river, I helped pay for your $400,000 share that you deducted. So that's why it's not right. It is like any other business expense, but it's an avoidable expense. If you hadn't violated the law, you wouldn't have had to pay that. So turn in your book to page 1066. Illustration 19-31. That tells you anything about how many illustrations are in this chapter. Look at number 1, interest received on, now first of all look at the heading. Items recognized for financial reporting purposes, but not for tax purposes. Interest received on state and municipal bonds. And number 2, expenses incurred in obtaining tax-exempt income. See, those two go together. Number 3, proceeds from life insurance carried by the company on key officers or employees, and proceeds paid for life insurance carried by the company on key officers or employees when the company is the beneficiary. And then number 5, fines and expenses resulting from the violation of law. Not only might you be penalized $1 million, but I don't know if you've ever aware of this. Sometimes the SEC, if it's very expensive for them to prove that you a company did something, they will fine you $10 million, and then they'll say, and you also have to pay all of our cost of investigating you. So you also have to pay $3 million in costs that we incurred in order to be able to prosecute you. So that would be expenses resulting from the violation of law. Okay, so now, if you can remember those 5, 2 that have to do with municipal bond interest income, 2 that have to do with life insurance proceeds, and then 1 that has to do with fines and violations of law, turn to page 1065. You don't have to memorize all of those in illustration 19-29. 5 and 6 is 11, and 4 is 15, and 3 is 18. So if you can memorize the 5, if it's not one of the 5, then it's got to be one of these. Now let me talk to you about some of those that are on there. I mean, we just talked about one, straight line depreciation versus tax depreciation. But here's another one, and we've talked about this before. Listen to it. For financial accounting purposes, if you are talking about an assurance type warranty, remember we estimate warranty expense and we credit warranty liability for our best estimate of what our costs are going to be to honor warranties on the products that we sold during the current year. You with me? For tax purposes, can you do that? No. For tax purposes, they say you can deduct that warranty cost when you pay it. Because think about it, the IRS wasn't born yesterday. What would people do if they could do that for tax purposes, if they could estimate? They would say, oh, I think our cost's gonna be like 25-30%. Well, wait a minute, our cost had never been more than 1.5% in any year. Oh yeah, but I think they're gonna be 40% this year. So they're gonna record a big old expense in order to lower their taxable income, put off pay, because you'd rather pay a tax bill today or a year from today. You won't put it off, don't you? Because you might get hit by a bus. Right? And you won't have to pay it in a year. There was a fellow one time, I tell you, this is a true story. At the bank, there was a guy who, this is what you call being smart. There was a gentleman who owned a business, he was a contractor, and he did paving. He would, if you build a new shopping center, he was the last one to come in and he put the asphalt or the concrete down and everything. He would repave your church parking lot and stuff like that. Extremely profitable company. But he would come to the bank every year and he would want a $1 million line of credit. Now this guy personally was wealthy and his business did extremely well because we got GAAP financial statements. So the loan officer comes in, the commercial lender comes in one day and says, we got this request from XYZ. And I look at the numbers and everything and I'm like, why does he need $1 million line of credit? He said, I don't know, but he wants it. Okay. Well, you know, one of the biggest things in lending is why? You have to ask yourself, why do they want this money? I mean, $1 million. Why didn't he say 250,000? Because he doesn't look like he needs to borrow any money from us. And I said, well, I'll write this up, but I mean, we gotta have some kind of an explanation. Why does he need $1 million line of credit? So he goes and asks him. He said, well, I tell you what I do. He had a year in that was January 31st. So his year was February 1 to January 31. He said, every year about October or November, I stop sending out invoices. But I keep right on doing work, paying my employees, paying my expenses, everything else. And then when I get to February 1, I send all those invoices out for November, December, and January. People who thought, ooh, maybe he forgot I owe him something. No, he didn't forget. He's doing the timing. Now listen, for financial accounting purposes, it doesn't matter because we record it when earned, right? When the performance obligation has been satisfied, it's time to book it. But for tax purposes, it wasn't taxable until collected. So what he did is in 1 year, when he started this, he had 12 months worth of expenses and let's say 9 months worth of revenue. So he postponed some tax liability, right? But then the next year, remember, he sent out a bill February 1 to all those people who owed him. So now he's got 12 months worth of revenues and 12 months worth of expenses. So once he starts this, he's got to do it every year or he's going to wind up with 15 months worth of revenues and only 12 months worth of expenses and have a big old tax liability. So he explained to the lender that his CPA had helped him come up with this idea. And that once he started it, he said, now you can't ever quit. You got to keep doing this. He said, so that's what I do. And so I use your line of credit in November, December, and January because I'm not getting any money from customers because I'm not billing them. But I got to keep paying my employees and paying for my equipment and everything else. I got to keep working. Okay? All right, so now wait a minute. 1986 comes along. And we have the Tax Reform Act of 1986. And it used to be that if you had revenues for the last 3 years that average less than a certain amount, you could be on the tax basis. You could be on cash basis, cash basis. But if you were somebody like IBM or Walmart, you were big, you wouldn't meet that threshold, so you got to be on accrual accounting for tax purposes. Well, they put a stipulation in the law, and he was above it. So he was all upset because now he's going to have to suddenly start paying accrual taxes. So not only is he going to have 12 months worth of taxes in 1 year, he's going to have an extra 3 or 4 months worth of taxes too. Until he talked with his CPA. What did the CPA suggest? It had been, I believe, if I'm remembering correctly, $10 million. And he was about $8 million in revenues. They changed it to $5 million. They wanted more companies to have to be on the accrual method to pay more in taxes. That was part of the concession that was made to get the Tax Reform Act of '86 approved. And here he sits at $8 million. So is he above the $5 million? Yeah. So suddenly now he's a big fish and he has to play by all the big fish rules. What did his CPA suggest?
Take in more cash? Take in more cash?
Don't you know invoices as much?
Well, if you don't collect them this month, in this year, you're gonna collect them next year. Here's what his CPA did. He said, why don't we create a separate company. We'll get all the way up to about 4.8 million in the current company. And the same people will go out and do the work. We'll just bill it under XYZ company name, and we can do another 4 million or so. And neither company has exceeded the $5 million threshold, so both can be on the tax basis. The fellow said he looked at him and said, I knew there was a reason I liked you. Now, that's not against the law. That's not illegal. They call that tax planning. And CPAs get paid good money to do that. I mean, we're not talking The Sopranos and taking people into a meat cleaver business and killing them and cutting them up and putting their body in lots of places, or not reporting income. He's reporting every dime of his income. It's just nothing that said he had to do it in one company. So he separated and did it in two companies. But this is what I told the loan officer, and the loan officer went back and told him. I said, but you know, eventually the ride will end. Because at some point, I mean, this man's not young, he's going to close the doors, right? And in that last year, all that deferred revenue is going to be realized, and it's going to be taxable. Well, this fella had thought that through. He said, that won't be my problem. I'll be dead, and that'll be the heir's problem. And now this was an interesting character, because I stood next to him at a Christmas party one day, and he told about having a safe deposit box. He bought some property years earlier and clear cut all the timber. And every penny of that money was in his safe deposit box. And he liked to go to Las Vegas and gamble. So he would always come by the bank and go to his safe deposit box. And he said, you know, that was 15 years ago, and I still got money in that damn safe deposit box. I'm like, I could help you. I'll go too and spend a little bit if you're intent on getting rid of it. But I mean, this is kind of the mentality that people who've gotten wealthy, one of the ways they get wealthy is they find ways to avoid, legally, some illegally, but most of them legally avoid paying taxes. Because if I have to give $40,000 to the bank, that's $40,000, I mean to the IRS, that's $40,000 I can't invest and I can't get wealthier off of. And with his case, I mean, he was very strong financially. I mean, we got his personal, because he's guaranteed his company's debt. I would see his personal financial statement, and the man was quite wealthy, liquid, multiple houses, no debt. The only debt he ever had was that stupid little line of credit. And he even though he wanted it for a year, he used it for about 5 months. He would use it November, December, January, and then in February and March, when the money started coming in, he'd pay off the line, say, I'll see you this time next year, and come back and do it again. So, the kind of thing that you get paid for doing tax planning. I would never have thought of that, 2 companies. Never. But that guy did. And I thought it was a really clever idea. Okay. Let me think if there's...
What about NOLs? That was on the note.
Sir?
NOLs, that was on.
Yeah, I think it's probably better to wait until we cover some of the basic stuff before we start doing net operating losses. Net operating losses are part of the chapter, but I think it's best to put them off for a little while. So, let's look at some problems or assignments. Turn to page 1095, please. And look at exercise 2. Page 1095, and let's look at exercise 2. now, as we do these, just like in the last chapter, I said, what is the process for revenue recognition under percentage of completion? We went through step 1, step 2, step 3. When we read these, when we encounter a difference, you have to immediately ask yourself, is it temporary or is this one of those 5 permanent differences? If it is a permanent difference, you do not recognize a DTA or a DTL. If it is a temporary difference, you then have to ask yourself, is financial income greater than taxable income? Or is financial income less than taxable income? And if it's the first, then you recognize a DTL, and if it's the latter, you recognize a DTA. So I put all this on the board because here's the thought process. When we read something that says, here are some differences, you need to ask yourself, temporary or permanent? If you say temporary, then you have to go to this. Think about, because of this one thing, what is the relationship between financial income and taxable income? Just focus on one thing at a time. Because if we have both something that gives rise to a DTA and something else that gives rise to a DTL, we handle them separately. Don't put them together. Don't make this harder than it has to be. All right, so let's look at exercise 2. The following information is available for Wenger Corporation for 2016, its first year of operations. Number 1, excess of tax depreciation over book depreciation, $40,000.
Do we have a DTA?
Is that a temporary or permanent difference? Temporary. Okay? Now, read carefully what it says. Tax depreciation over book depreciation. Book depreciation meaning GAAP, your books. All right, so as a result of this, what does this give rise to? A DTA or DTL? DTL. Okay? So now, it tells me, I believe, that that difference reverses equally over the next 4 years. Right? So here's what's important. If they told you the tax rate in 17 is going to be 30%, and in 18 is 30%, and in 19 is 40%, and in 20 is 40%, then you're going to add these two together and multiply by 30% to get the amount of this DTL, and then these two together and multiply by 40%, and then add the two together to get the total DTL. You with me? Now, in this case, they're going to give you the same tax rate in all years. But later, they may say, okay, this is going to be 30%, 30%, 40%, and 40%. So now the DTL is going to be 20,000 times 30% plus 20,000 times 40%, add them together, and that's the amount of your DTL. So you map out when it's going to reverse. Okay, look at the next one. So you've written by the first one, DTL, and then put 40,000 times, and we'll see, they haven't told us the tax rate yet. Okay, now look at number 2. Deferral. What does that mean, deferral? Put off. Put off. For book purposes of $20,000 of rent received in advance. Now, what does that mean? First of all, is that a temporary difference or permanent difference?
Temporary.
Temporary. Okay, good. Now, as a result of that, what's the relationship between financial income and taxable income?
Financial would be less. Right?
It's greater.
Yeah, financial's greater than tax.
He said less. You said greater.
Yeah.
You're putting off
I say
the rent that you're receiving.
That's a-
asset account, right?
Well, for taxes, you have to, as soon as you get the money, you have to, like, account for it, right?
Mhm.
So your financial would be, less than your tax, cause you're already have to account for it for taxes.
They're right. Financial income will be less because, look, you have deferred it for book purposes. When you're paid money in advance, for financial accounting purposes, you debit cash and credit unearned revenue. Okay? But for tax purposes, when you get cash in your hands, you pay taxes on it. That's why they say. So this would give rise to a DTA in the amount of 20,000 times something. All right, pre-tax financial income is 300,000. Your tax rate for all years is 40%. Okay, now you know what the tax rate is. Go back and multiply the 40,000 times 40% and your 20,000 times 40%. Did they tell me this was 300,000? Okay. And then my differences, depreciation and rent revenue. That was 40,000 and 20,000. And this gives me taxable income. Okay, but now, you gotta tell me, do I add or subtract the 40,000? I'm going from what's on my GAAP income statement to what's gonna show up on my tax return. So should I add or subtract the 40? Subtract. And then do I add or subtract the 20? Add. All right, so what do you got, 280? So taxable income is 280,000. Are you with me? That makes sense? Now, sometimes they're going to start you at taxable income and want you to come up with financial income. So you just go the other way. Okay, so that was letter A. Letter B says, prepare the journal entry to record income tax expense, deferred income taxes, and income taxes payable for 2016. Okay, so what would the journal entry look like? At 12/31 of 16, that's the end of this first year.
17. Is it not? No, never mind, sorry.
It's the difference. Debit, income tax expense. But that's a plug, so we don't know how much that's gonna be. Do we have something giving rise to a DTA this year?
Yes.
Okay, DTA, debit. Or do we know the amount of the DTA? 20,000 times 40% is, how much? 8,000. Do we have something giving rise to a DTL this year? Yes. So credit DTL. 40,000 times 40% is 16,000. And then income tax payable. How do you get income tax payable? Taxable income, which is 280,000, times the current tax rate, which is 40%. 4 times 8 is 32, 2 period 312,000. So now we're at 128, so income tax expense is 120. Are you with me? Now you see, we're starting simple. We got one of both, same tax rate, learning to do this, and then we're gonna slowly crank up the wheel. Are you with me? Okay, look at C. Oh, I'm sorry, I should have done this too. The thing giving rise to the DTA is all reversing in 1 year. Next year. Look at letter C. Prepare the journal entries to record income tax expense, deferred income taxes, and income taxes payable for 2017, assuming taxable income is $325,000. What should I do here? Ms. Finch, get me started. Debit, DTL. Okay, what else should I do?
Income tax expense.
Income tax expense. What else should I do? Mr. Jackson?
Credit DTA.
Credit DTA. And what else should I do? Credit income tax payable. Okay, to get income tax payable, we're going to take the 325,000 and multiply by 40%. 4 and 5 is 20, 0, period 2, 0, 140,000? Huh? 4 and 3, 12, 13, 14. Tell me again. 130? Okay, that's income tax payable, 130. Everybody sees where that comes from. Now, what are we gonna do with DTA? Ms. Walker?
DTA, credited it for 20,000.
20,000? Okay, I want you to look up here. When you created the DTA,
Oh.
you only created it for 8,000.
8,000.
20,000 times 40%.
Yeah.
So now we're going to credit it for the 8,000. Ms. Pitts, what are we gonna do with the DTL?
The 16,000?
How much is reversing this year? Okay, look up here. Here's depreciation and here's the rent. How much of the 40,000 temporary difference arising last year is reversing this year? 10. Right? Times 40% would be 4,000. So now we're back into income tax expense is 134,000. Are you with me? So now see, Ms. Walker has already fallen prey to confusing the DTA with the amount of the cumulative difference, giving rise to the DTA. right? And I told you it was gonna happen, it's just normal. If we were looking at the DTA account, it would be 20,000 times 40% is 8,000. So probably if I had gone to the trouble of putting the T account up here, she would have, yeah, she's shaking her head, yeah, I would have got it right if you'd have done that.
It's been drawn circles.
But I don't go home with you and I don't prepare the T accounts for you. You need to prepare the T account so you can see it. Are you with me? Question?
So because, the DTL reverses in 40 years, you only do for each year?
Only, yes,
Okay.
the part that's reversing this year. So now, next year, assuming everything stays consistent, 12/31/18, we would debit income tax expense, debit DTL for another 4,000. We don't do anything to DTA because it's gone. And then we credit income tax payable for taxable income times the future tax, current tax rate.
And if there's like multiple, like if there's a different DTA in the next year,